For decades, the world's most powerful financial institutions told you that gold was a relic, a barbarous asset from a bygone era. They built a global financial system on something else entirely: trust in the US dollar. But behind closed doors, they've been hiding a secret. They never actually stopped believing in gold. And now, that quiet accumulation has turned into a full-blown stampede. In the last few years, central banks have been buying gold at a historic pace, with over 1,000 tons purchased annually between 2022 and 2024. They're not just buying it, they're moving it out of foreign vaults in New York and London and bringing it home. The question isn't if they're preparing for a world where the dollar's absolute dominance is fading. The question is why. And what do they know that you don't? To understand what's happening today, we have to go back in time, to the moment the DNA of our modern financial system was written. For much of the 20th century, the world operated on a gold standard. The pinnacle of this was the Bretton Woods Agreement after World War II. The system wasn't perfect, but it had a simple, powerful anchor. The US dollar was tied directly to gold, and every other currency was tied to the dollar. Each dollar was a claim on a fixed amount of physical gold held in US vaults. It provided stability. It imposed discipline. A government couldn't just print money without limit because it had to have the gold to back it up. But in 1971, that all changed. Facing massive economic pressures, including the cost of the Vietnam War and a run on its gold reserves, US President Richard Nixon made a stunning announcement. He cut the final cord connecting the dollar to gold. This Nixon shock was the birth of the financial world we live in today. Overnight, the world switched from a system backed by a tangible asset to a system backed by nothing but faith. It became a pure fiat system with the US dollar at its heart. Fiat is Latin for let it be done. In other words, money has value simply because a government says it does. Its value is based entirely on trust in the US government, its economic might, and its political stability. For half a century, this system more or less worked. The world needed a global reserve currency, and the dollar was the only real candidate. The US had the biggest economy, the deepest financial markets, and the most powerful military. The petrodollar system, where oil was priced and traded in dollars, cemented this dominance. Nations had no choice but to stockpile massive amounts of US dollars and treasury bonds as their main reserves. This gave the United States what a French finance minister famously called an exorbitant privilege. America could borrow more cheaply than anyone and run huge deficits without facing immediate consequences. The world needed dollars, and America could print them. But this system, built on trust, contained the seeds of its own undoing. And the very central banks who managed this new world were quietly preparing for the day that foundation would crack. They started buying insurance. They started buying gold. For years, central banks were actually net sellers of gold. In the relatively stable 90s and 2000s, it seemed logical. The Cold War was over, globalization was booming, and the dollar's reign felt absolute. Selling gold to buy US treasuries that paid interest looked like a smart move. Then came 2008. The global financial crisis, which started in the US housing market, sent a shockwave across the planet. It was the first major tremor to shake the world's faith in the US-centric financial system. And if you look at the data, that's the exact moment central banks stopped selling gold and dramatically reversed course. They have been net buyers of gold for 15 consecutive years. What began as a trickle after 2008 has now become a flood. Since 2022, central banks have been hoarding gold at a pace of over 1,000 tons annually. This isn't just a market trend, it's a massive policy shift by the world's most powerful financial institutions. To understand this quiet panic, you have to look at the three big problems they're trying to solve. The first crack appeared when the dollar, long seen as a neutral tool for global trade, was turned into a weapon. The United States realized that by controlling the plumbing of the world's financial system, it could cut entire nations off from the global economy. The turning point was the freezing of hundreds of billions of dollars of Russia's central bank reserves in 2022. For finance ministers everywhere, this was a shock. These weren't a company's assets. This was the sovereign wealth of a nation, held in currencies that were supposed to be the safest on earth. The message was loud and clear. If your country falls out of favor with the West, your national savings can be frozen with the flick of a switch. Suddenly, holding dollars or euros wasn't risk-free. It came with a terrifying new risk. The person on the other side of the deal, the counterparty, could simply decide not to pay. The value of your reserves now depended on the goodwill of the country that issued them. This sent a chill from Beijing to Riyadh, from Ankara to New Delhi. How could they protect their nation's wealth from being a geopolitical bargaining chip? The answer was an asset with no counterparty risk. An asset outside any single nation's political control. An asset that can't be printed, devalued, or frozen. That asset is gold. Gold is the only reserve asset that isn't someone else's liability. It's physical, it's final, and if you hold it in your own vaults, it is under your absolute control. This is why we're seeing a massive repatriation movement alongside the buying spree. Nations like Germany, Turkey, and India have been moving tons of their gold out of vaults in New York and London and bringing it home. A 2025 survey revealed a sharp increase in central banks storing gold domestically, with 59% now doing so, up from 41% the previous year. It's a clear vote of no confidence in the safety of the old financial architecture. The weaponization of the dollar didn't just cause a defensive rush into gold, it supercharged a strategic goal among rising powers: de-dollarization. This isn't about the dollar collapsing overnight. It's a slow, deliberate shift to reduce reliance on it for global trade and finance. And the countries leading this charge are the same ones topping the gold buying league tables. Take China. By late 2025, the People's Bank of China had steadily increased its gold reserves for many consecutive months, pushing its official holdings beyond 2,298 tons. Many analysts believe its actual reserves are far higher. For Beijing, gold is a key part of its long-term strategy to internationalize its own currency and insulate itself from US financial pressure. Then there's Russia. Since facing sanctions, Russia has massively boosted its gold reserves, which now stand at over 2,330 tons. It's a clear strategy of dollar replacement. But it's not just China and Russia. The BRICS bloc, now expanded to include major energy producers, is actively building the infrastructure for a post-dollar world. They are developing alternative payment systems to trade directly in their own local currencies, bypassing the dollar-based SWIFT system entirely. India has been a major buyer and is bringing its holdings home, while Poland has led European buying over fears of regional instability. These actions have contributed to the dollar's share of global reserves falling significantly from its peak. It's a coordinated realignment of the global financial order, and its architects see gold as a neutral foundation for a more multipolar currency world. The third driver behind the gold hoarding is the most insidious, and it affects every single one of us: the slow, relentless erosion of the value of paper money. The fiat system that began in 1971 allows governments to create money from thin air. And for the last 2 decades, especially after the 2008 crisis and the 2020 pandemic, they have done so on an unprecedented scale. This massive expansion of the money supply was meant to stimulate economies, but it came with a huge cost currency debasement. More dollars, euros, and yen chasing the same amount of goods and services means your money buys less. The numbers are stark. In the years following 2020, major currencies lost a significant amount of their purchasing power due to high inflation. For a central bank holding billions in these currencies, these are catastrophic losses. This is where gold plays its most ancient role, a true store of value. Unlike paper money, you can't print more gold. Its supply is finite. Throughout history, during times of high inflation, gold has proven its ability to preserve wealth. Central bankers know this better than anyone. They see their own balance sheets swelling with fiat currencies that are losing value every year. So, they hedge. They buy the one asset that has maintained its purchasing power for millennia. The buying surge that began in 2022 and has continued since proves this isn't a short-term trade. It's a strategic reevaluation of money itself. They are hedging against the very system they're supposed to manage. What we're talking about is a fundamental shift in the global balance of power, hidden in the balance sheets of the world's most secretive institutions. If you're finding this breakdown valuable and want to understand the forces shaping our financial future, take a second to subscribe and hit that notification bell. The sheer scale of this movement is hard to overstate. After averaging 400 to 500 tons of annual purchases for a decade, central banks more than doubled that pace, buying over 1,000 tons per year in both 2022 and 2023. The buying has remained exceptionally strong since. That's a massive portion of the world's total annual gold production being soaked up by these institutions alone. This isn't just opportunistic. The record-breaking purchases have continued even as the price of gold surged to new all-time highs. This tells you that central banks are strategic, price-insensitive buyers. They aren't trying to time the market for a quick profit. They are accumulating a core asset for the long haul. The consensus among these powerful institutions is striking. The 2025 Central Bank Gold Reserve Survey found that a staggering 95% of central bankers expect global gold reserves to increase over the next year. The people in charge of the world's money are nearly all in agreement. The move into gold is just getting started. The report cited gold's performance in crises, its role as a long-term store of value, and its power to diversify as key reasons for the buying. This represents a quiet dethroning of the US Treasury bond as the undisputed premier reserve asset for a huge portion of the world, and the re-enthroning of gold. When you see the smartest money in the room moving in such a coordinated and dramatic fashion, it's a signal you can't afford to ignore. They are sending a clear message about their declining faith in a purely dollar-based system and their growing conviction in the enduring value of gold. So what does this colossal behind-the-scenes shift mean for the world? And more importantly, what does it mean for you? First, it signals the definitive end of the unipolar financial moment. The dollar's absolute dominance is giving way to a more multipolar, fragmented system. The dollar will likely remain the most important currency for the foreseeable future, but it won't be the only game in town. In this complex new world, gold is re-emerging as the neutral, trusted anchor, a common denominator of value between competing currency blocks. Second, for the price of gold, the actions of central banks provide a powerful and structural tailwind. This consistent, massive buying from institutions that don't care about short-term price swings creates a huge floor under the market. Unlike other investors who might sell, central banks are accumulating for strategic, generational reasons. Finally, and most crucially, what does this mean for your savings and your financial future? The actions of central banks are a giant warning sign. The very institutions that manage the global fiat system are taking massive steps to ensure against its biggest weaknesses. They are protecting their wealth from the exact same risks you face. The erosion of your savings through inflation, and the instability that comes from geopolitical risk and a debt-based financial system. The financial uncertainty so many people feel isn't just a feeling, it's a reality the world's most powerful bankers are actively preparing for. They're looking at the mountains of global debt, the persistent inflation, and the fracturing geopolitical landscape, and they are buying the ultimate form of financial insurance. This isn't about predicting doomsday. It's about recognizing a profound long-term shift in the nature of money and power. It's about paying attention to what the smart money does, not just what it says. They told the world gold was a relic, while quietly hoarding it at a record pace. Their actions speak far louder than their words. So why did central banks never really give up on gold? Because they always knew the secret. In a system built on trust, you must always have a backup for when that trust begins to fade. For 50 years, the world ran on the dollar standard. But the architects of that system are now leading a quiet revolution. They are systematically hedging their bets, driven by the need to de-risk from sanctions, the strategic push to de-dollarize, and the undeniable reality of currency debasement. The record-breaking gold rush of the past few years isn't an anomaly. It's the logical conclusion of a system reaching its limits. The actions of central banks are a clear signal. They're playing a long game, and the rules of money are changing. They are preparing for a future that looks very different from the past. And understanding this trend is the first, most crucial step to protecting your own wealth in an increasingly uncertain world. What do you think is the biggest reason for this global gold rush? Is it the fear of sanctions, the decline of the dollar, or something else entirely? Let me know your thoughts in the comments below. And for more deep dives into the forces shaping our financial world, make sure you're subscribed.